Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's unpack this. We are living in a market that is, well, it's absolutely obsessed with AI software.
Completely.
Everyone is looking for the next app, the next model, the next chatbot that's going to change the world. But while everyone's looking at the shiny storefront, I feel like the real wealth is being built in the plumbing.
The plumbing is exactly the right word. It's the infrastructure. It's all the heavy lifting that powers this revolution. And that is exactly where Nebius Group sits. Because, while everyone's betting on which horse wins the race, Nebius is the one building the track.
With him selling the tickets to the grandstand.
Precisely. We have a stack of reports here, financials from late 2025, analyst notes from early 2026, and the technical charts. And the picture they paint is, well, it's intense. We're talking triple-digit growth, massive volatility, and a relationship with NVIDIA that might just be their golden ticket.
Right, and just to set the stage here, today is Tuesday, February 3rd, 2026. The numbers we are looking at for this company, they're startling. We aren't talking about some small startup hoping to make a sale.
No, not at all.
We are talking about a company that has secured over $20 billion in backlog contracts.
And is seeing triple-digit revenue growth to back that up.
Exactly. So let's dive right into the growth story here. Because when I looked at the headline numbers for the first 9 months of 2025, I honestly had to double check them. Revenue hit $302 million. But specifically in Q3 of last year, they grew 355% year over year.
It's a massive acceleration. Most companies, even high-growth tech stocks, they're happy with 20 or 30%. But Nebius is effectively quadrupling its business.
Right.
And what's fascinating here is the trajectory. If you look at where management is guiding, they aren't just expecting this to continue, they're expecting it to compound. They guided for an annual recurring revenue, an ARR, of somewhere between $900 million and $1.1 billion by the end of 2025.
Which is huge in itself. That puts them in the unicorn category for revenue alone.
It does. But here's where it gets really interesting. They are projecting that number to jump to between $7 and $9 billion by December of this year, 2026.
Wait, hold on. We need to pause there. So we go from roughly $1 billion to potentially $9 billion in ARR in, 12 months? That sounds optimistic, almost dangerously so. How do you bridge that gap without some kind of magic?
It sounds impossible until you look at the safety net they have in place, and that goes right back to that $20 billion backlog you mentioned.
Okay.
These aren't hypothetical sales. These aren't, we hope someone buys our compute. These are pre-sold contracts.
So these aren't just hopes and dreams.
No. This is pre-sold capacity. In the SaaS world, software as a service, you usually have to fight for every renewal. You have churn. Here, the dynamic is inverted. The demand for high-end AI compute is so insatiable that the titans of the industry, we're talking hyperscalers like Meta and Microsoft, are locking in multi-year deals just to make sure they have a place to run their models.
So essentially the capacity they are building right now, it's already spoken for.
Exactly. It offers a level of revenue visibility that most companies, they can only dream of. The question isn't, can they sell it? The question is, can they build it fast enough?
Which we will definitely get to, because building physical infrastructure is a whole different beast than shipping code. But before we get to the risks, I want to push back on the business model a bit.
Sure.
I have to play devil's advocate here. What prevents Amazon or Google from just crushing them? AWS and Azure have basically infinite money. They own the internet. Why do they need Nebius? What's the moat?
That is the crucial question. Because you're right, if Nebius was just buying chips and renting them out, they'd be dead in the water. It's a race to the bottom on price.
Right.
But Nebius isn't just a reseller. They have built a vertically integrated platform. They have their own GPU clusters, their own proprietary cloud software, their own developer tools. But the real moat, the thing that makes them so sticky, is their status as an NVIDIA cloud partner.
Explain that for the listener who might not follow the hardware wars that closely. We hear partner thrown around all the time in tech. Silver partner, gold partner. It usually just means you get a discount on licensing. Why does this partnership matter?
It matters because of access to physics. In the world of AI, speed is everything. Being a preferred partner means Nebius gets early access to the absolute cutting-edge hardware. We're talking about the Blackwell Ultra Compute and the Rubin platform, specifically the Vera Rubin NVL72 systems.
The Vera Rubin systems. That's the next generation stuff, right?
Yeah, it is. Think of it like this. Previous generations of AI chips were like separate, super fast computers connected by cables. The NVL72 is designed so that 72 of these massive GPUs act as a single giant brain. It changes the physics of how fast you can train a model.
And I'm guessing you can't just plug that into a standard wall outlet.
No. And that's the other part of the moat. These things run incredibly hot. They require advanced liquid cooling, specialized power delivery, heavy floor loading. Most legacy data centers, the ones built 5 years ago for your emails, they physically cannot handle these machines. Nebius is building the specialized gym just for these heavyweight athletes.
So if I'm Meta and I build my next generation model on this specific cutting-edge architecture that Nebius has,
You're locked in. The switching cost becomes incredibly high. You can't just easily unplug and move to a generic cloud provider without re-engineering how your models actually run. That hardware lock-in is powerful.
and they're doing it efficiently. One detail that really stood out to me in the reports is their headcount. They've done all of this with a pretty lean team of, roughly 1,371 employees.
That is very lean, especially for a company aiming at $9 billion in revenue.
It suggests a really high revenue per employee potential as that revenue scales.
Exactly. I mean, once the pipes are laid, you don't need thousands of people to turn the valves.
Okay, so we have explosive growth, a massive backlog, and a technological moat. But let's pivot to the charts because the stock price and it tells a story of its own. And looking at the technicals, this is not a smooth ride.
No, it certainly isn't. Not for the faint of heart.
So I'm seeing a beta of 4.0. For those listening, that basically means if the market moves 1%, this stock tends to move 4%. It is volatile.
It's a high-octane stock.
And looking at the last 12 months, we saw a run-up of somewhere between, 176 to 200%. It went parabolic. But recently, we've seen a pullback. It corrected about 30 to 33% from its highs of around $141 down to that $90 to $99 range.
Which, to be fair, for a growth stock like this, is actually a pretty standard correction. When things go up that fast, they eventually run out of buyers, and they need to cool off.
Right, and that's what I want to unpack. When I look at this chart, I don't see a crash. I see what traders call a bull flag. It's consolidating. It had this massive run, and now it's just catching its breath. The key here is that support around the mid-90s seems to be holding.
And what's the volume telling you?
That's the good news. The volume has been average hovering around 11 or 12 million shares. If this were a panic dump, or if the story was broken, you'd see volume just spiking as everyone rushed for the exits. We're not seeing that. We're just seeing a cooling off period.
Which aligns perfectly with the fundamental picture, right?
Yeah.
The market is waiting for the next data point to confirm that the growth story is still on track. They priced in all that initial excitement, and now they're waiting for the proof.
Which leads us perfectly into the vibe of the market right now, the sentiment. When you look at the broader market mood, what are you seeing?
Quantitatively, it's strongly bullish. If you look at the analyst coverage, the consensus is sitting at a moderate buy to buy. The price targets average around $142, which is a nice upside from here. But some of the street highs are reaching as high as $211.
Wow. That would be a double from current levels.
It would. And it's not just analysts talking. We are seeing institutional flows backing it up. For instance, Fred Alger Management's Small Cap Focus Fund has highlighted Nebius as a key holding.
Why does that matter to the average listener?
Because funds like that are smart money. They specialize in finding these high-growth compounders early on. When you see funds like that, funds that do really deep due diligence taking a position, it signals a level of institutional trust that goes beyond just, retail hype. They've crunched the numbers on the backlog, and they believe it's real.
So the smart money is positioning itself. But markets run on catalysts. We can stare at a backlog all day, but what is going to make the stock move now?
The immediate trigger is staring us right in the face. Q4 earnings are imminent. We're expecting them mid-February, probably around the 12th or 19th.
That's effectively 2 weeks away from our recording date.
Exactly. And the expectations are high. The market is looking for confirmation of that explosive revenue trajectory we talked about. If they deliver a beat and raise, meaning they beat the expected numbers and raise their future guidance, that could be the spark that triggers the breakout from this whole consolidation pattern.
And beyond earnings, what's next?
It's the product launches. We mentioned the Rubin platform, but there's also the Token Factory for AI inference.
Okay, let's unpack that. Token Factory. I'm assuming we aren't talking about crypto tokens or arcade coins here.
No. In large language models, a token is basically a piece of a word. When you ask ChatGPT a question and it writes back to you, It is generating tokens.
Right, gotcha.
Up until now, a lot of the focus and the money has been on training AI models, teaching them to be smart. That's huge, heavy lifting, but Nebius is moving into running them. That's inference. That is where the long-term, high-margin business really lives.
So training is building the gym, inference is charging people to work out.
Perfect analogy. And the token factory is designed to capture that workout market. It's a crucial shift because inference tends to be a more stable business over time. If they can capture that, they aren't just a training shop. They become the utility company for the entire AI economy.
Okay, so everything sounds rosy. We've got growth, catalysts, a bull flag.
Right.
But this is smart wealth, and we don't just drink the Kool-Aid here. We have to look at the other side. I want to play devil's advocate for a minute.
Please do. There are definitely risks here.
The first one that just jumps out at me is cash burn. This kind of growth is expensive. When I look at the balance sheet, the non-current debt is sitting at over $4 billion. That is a heavy load.
It is significant leverage. There is no denying that.
And profitability, or the lack of it. Despite that triple-digit revenue growth, they are still generating losses. Net loss was $120 million in Q3 of 2025. And I saw one metric that really scared me, a 236% earnings decline in 2024 because of how much they were spending.
That's the reality of infrastructure plays. You have to spend the money to build a data center before you can charge Microsoft to use it. It's extremely capital intensive. It's that valley of death they have to cross.
So they're burning cash to build the assets that will eventually generate the cash. If they stop spending, they stop growing. And then there's the valuation. I mean, depending on how you squint at the numbers, the PE ratio is effectively negative or over 100 times earnings. You are essentially paying for perfection in 2027, not for performance today. If they stumble, that multiple compresses fast.
You're absolutely right. The valuation assumes they hit that $7 to $9 billion target if they miss. If they only hit $4 billion, the stock re-rates lower and it will happen fast.
And that brings me to execution risk. You mentioned they need to go from 220 megawatts to 1 gigawatt of capacity. I mean, building data centers isn't like pushing a software update. It involves concrete, power cables, permits. It's hard.
It's incredibly hard, and it's getting harder. You have supply chain delays for cooling systems, you have construction delays, but the biggest bottleneck of all is power. Finding a gigawatt of power is not easy. You can't just call up the local utility and ask for it. It takes years of planning.
So if Nebius misses their construction timelines,
They can't recognize the revenue. That $7 to $9 billion target is entirely contingent on them physically building the space to host the machines. If the concrete doesn't dry fast enough, the stock crashes.
and we can't ignore the macro factors either. They have a pretty big footprint in Europe.
Right, they aren't just in Silicon Valley.
So if we see energy cost spikes in Europe, or if tariff policies change regarding shipping these high-end ships across borders, their margins could get squeezed even tighter.
That's a fair point. Geopolitical friction is a real risk for a company that relies on moving advanced silicon across the globe.
So we have a company with a massive backlog and massive debt, explosive growth and explosive spending. It's a real high-wire act.
It is, but that is often where the alpha is found. If it were safe, it wouldn't be priced with this kind of upside potential.
So let's get to the verdict. We've looked at the fundamentals, the charts, the sentiment, and the bear case. When you weigh all the pros and cons, the execution risk versus that $20 billion backlog, how do you score this?
When I put it all together, I'm giving Nebius Group a bullish score of 8 out of 10.
An 8. That's high conviction given the risks we just laid out.
It is, but the math is compelling. The risk is certainly high. I mean, the debt and the execution challenges are very real, but the reward is mathematically visible. It's not a guess. We can see the contracts. We know the Meta, Microsoft, are good for the money. It's not like they're selling to startups that might go bankrupt.
So what's the investment thesis here? What's the elevator pitch?
The elevator pitch is simple. The world is structurally short on power and compute. We have an insatiable demand for AI processing. Nebius has the supply, and more importantly, they have the contracts. They have solved the hardest part of the equation, which is finding the customers who will pay for it.
So how do you play it?
Strategically, this looks like a buy-the-dip candidate. This 30% correction we're in right now, that's the entry point. But, and this is key, you are not buying this for a trade next week.
Unless you love ulcers.
Right. You are looking for a multi-year hold into 2027. You need to hold through this construction phase until those massive infrastructure investments start turning into positive cash flow.
And I'll add a note of caution here myself. This is going to be a volatile ride. With a beta of 4, you are going to see days where this stock drops 10% because of a rumor and then goes up 15% because of a press release. It is not for the faint of heart.
Absolutely. Position size accordingly. This shouldn't be your entire retirement fund.
Right. It's a rare chance to buy infrastructure with hypergrowth characteristics, but you have to have the stomach for it.
Exactly.
Now, before we sign off, I want to leave you with one final provocative thought. We know Meta and Microsoft are already locked in. They're the anchor tenants. But with the capacity Nebius is building going to a gigawatt of power, who is the next massive buyer they haven't announced yet?
That is the multi-billion-dollar question.
Is it a sovereign wealth fund building a national AI model? Is it another tech giant, maybe Apple or Amazon, realizing they are behind on capacity?
Or a massive pharmaceutical company doing drug discovery.
Exactly. When that next name drops, the whole narrative changes again. It goes from they have a few big clients to they are the industry standard.
It certainly does.
We'll leave you to mull over that. Thank you for listening to Smart Wealth with Joshua. Remember to subscribe and drop a comment below on the specific stock you want us to analyze next. We read all of them.
Thanks, everyone.
We'll see you in the markets.